Okay guys, so we'll run through a quick summary of the key things that you need to remember from day one. Start off with capital markets. So what was the point in capital markets? It is for funding. It is for those with excess funds, investors. These could be pension funds, high net worths, mutual funds, etc. For them, they want some kind of return. They want some kind of diversification of their funds. They're not going to sit it all in the bank. So they will hand over some of their cash to company or a government, and in return they will get either shares or bonds of companies or governments, and hopefully as well you will get a yield. Now the yield is going to come in terms of a dividend if you're owning shares, or it's going to come from the coupon, the interest paid on those government bonds. So that's the reason that you want to do it. Each side wants the cash or wants to do something with their cash. So it's just essentially a switch of money, of assets. How they're sold, first up, they're into the primary market. This is in the form of an IPO or a government auction. Not of huge importance, but we will talk about it later on. They're sold via a larger bank, primary dealers, into that primary market, who then will sell them on into the secondary market. This is when they become public. So this is the secondary market, and they can then be traded. This is what we're all watching for. This is where you can trade the shares. You know, once you've taken the capital gain that you feel you want, you can sell those shares, and that is how they get traded. You know, it is basically a balance of opinions. Of some people want to hold them longer, so always keep in mind what people's motivation is for buying those shares. Is it a short-term appreciation for the next few hours? Is it a longer-term investment they want to keep in view of getting a yield, in view of maintaining a longer, more diverse portfolio? Now, the beauty of the secondary market, it allows you to spot the performance of shares, government bonds. It also gives a gauge to those who own the companies as to how well they're doing, and it directly affects the knock-on when they next come to issue bonds or shares. Because if your share price has fallen, any additional funding is going to yield you less, because you're going to sell the shares at a lower price, meaning you get less cash for them. So you have less room to expand. Likewise, government bonds start falling in price, the yields go up, so the next time the government borrows, they have to do so at a higher interest rate. So that's capital markets. In terms of what you're actually trading in capital markets, you've got the shares and bonds. Now, the shares are generally deemed as higher risk compared to bonds, which are lower risk. Why are they lower risk? Because with a bond, you are guaranteed, or you should be guaranteed, your money back once the bond matures. They vary in terms of risk. If you go up as far as government bonds, you know, particularly AAA government bonds like the US, for example, or Germany, they're generally seen as the safest investments you can get. Corporate bonds, a little bit less so. You know, smaller companies issuing bonds will probably have to do a higher yield because of the risk involved. So that's in terms of risk. So generally you will see a switch. If people are buying more shares, chances are the bonds are going down. You see this inverse relationship between the two in general. Now, in terms of return, obviously with shares, you are looking for your capital to appreciate and your dividend. And with the bonds, it is all about the yield. Now remember, bond yields move inversely to price. So if price goes down, yield goes up. Reason for this is the coupon that is paid on the bond, which is the yield, always stays the same. So if, say, you buy a $100 bond with a $10 coupon, so that is essentially 10%, and that bond drops to trading, sorry, $100, not 1,000, that's 10%. If that bond drops down to 50 and it is still paying you 10, because it always will, the coupon remains the same, you are now getting 20% return. So that's the basis of it. remember that inverse relationship between the two. Keep your eyes on yields, on yield levels as well. They're going to be very, very important. Now, big things that influence them. Remember, you are watching out for company earnings. You also want to be looking out for M&A, mergers and acquisitions. If one company tries to buy another, then obviously that is going to drive up the share prices. So these are things you want to be really focusing on. The sectors that your companies are in, or the major sectors in the index that you are trading. So for example, if you were trading DAX, the German stock index, there are 3 extremely large auto companies. So auto companies are going to have quite an influence on the DAX, for example, but less so if you're looking at the FTSE, which does't have so much. And so you need to know what your index is focused on in terms of sectors, and also the individual shares within a sector will be influenced by the other shares. Think back to that VW emission scandal example. And then of course you've got regulation in terms of taxes, in terms of environmental regulation. That's going to potentially push up companies' costs. So they're the things you really want to be focusing on in terms of companies. With your bonds, it is all about monetary policy. That's going to be your main focus, but particularly towards the shorter end, so 2-year bonds and less, because they are directly influenced by the monetary policy. They're not going to be affected by inflation, which is the next big issue for bonds, and that's going to affect you 5-year plus, because as inflation rises, that yield over time becomes less. If you've got inflation rising at 10% and you're only earning 10%, effectively you are earning 0. So the inflation element of it does affect the longer end a lot more, because it's your forward return that you're looking at. If inflation is going to continue rising, your forward return is actually less. So in a high inflation environment, your longer end bonds are going to sell off so that the effective yield you get compensates for the interest rate issue. Sorry, not the interest rate, the inflation issue. And then, of course, you have credit worthiness. As I said, you can judge this by the ratings agencies. The most credit-worthy bonds are generally seen as AAA. So this means that you are almost certain to get your money back on the bond. It also means that you are probably going to get less yield. But it's the question of, are you willing to forgive that yield for the safety? And this is where you see this scarcity issue sometimes, and a rush towards certain bonds because they guarantee you your money back, and that's what people want in time of crisis. Hence the low risk element. In times of uncertainty, you should see a shift from shares to bonds. Now, next markets we're going to look at are markets that offer you no return. So you get no dividend, no coupon. It is just a purely supply and demand based market whereby people will want currency or commodities based on the fact that they need them for one reason or another. If you think about currencies, why do you need currency? You're going to need this. You're going to need it for exchange products. So for actual goods, it's all about exchange really. So you're looking for goods, investments, so financial goods, you're looking to invest, buying other companies. You see examples in a smaller country. If, say, their largest company is to be bought out, you will actually see quite a big move in their exchange rate as money is needed to be switched into that currency to actually buy the large company. Do watch out for your influences though, and these are going to come in the space of monetary policy. Monetary policy is going to generally push up the value. So if interest rates, so rates go up, currency goes up in general. Why is this? Because if the interest rates are higher in one currency, you could move your cash to that currency, put it in a bank there, earn a higher rate of interest on it. So therefore you get a demand for that currency. However, inflation is the other side of that coin. If inflation is rising too quickly, then whilst yes, you're going to get a return on your interest rates, the currency is likely to fall because goods will spiral out of control. So as the inflation rises, everything becomes more expensive. Your rate actually effectively drops because prices are rising more than the rate of return you're getting, and therefore you will actually see the currency begin to fall because demand is going to drop for that currency because the prices are going up. From an external investor's point of view, you're not going to want to buy their products because they're so much more expensive now due to the currency move. Right, fiscal policy. Government's borrowing more money. That's, again, going to increase the supply of money, and therefore more supply, currency will fall in value. You want some diversity as well. Certain currencies, I would suggest New Zealand dollar and CAD are very influenced by commodity prices. So therefore, if there is limited diversity, they are just going to be affected by the commodities rather than other elements, other things going on in your economy. It's purely going to be a supply demand for commodities. And beyond that, remember stability. If you have a country that is quite unstable or likes to get involved in their currency by talking it up or down, then you're going to see some currency fluctuations on that. Remember the South African Rand example where they sacked their economy minister, and remember the Bank of Japan example where they will talk up their currency, say that more intervention could be coming in order to adjust the value of their currency. Now, commodities, you've got four major ones. You've got your energy sector, energy, metals, agriculturals, and livestock. So four quite different sectors, and these are going to be influenced by different things generally. One thing to note is they are generally all priced in dollars. So if you start seeing the dollar rising, then this affects commodity prices because if you are not earning in dollars, then the dollars are more expensive, therefore it is pushing up the value of your commodities that you need to buy. So supply demand for commodities is quite well linked to the dollar. Also, think about geopolitics, particularly in commodities that are influenced by a small number of companies, e.g. oil and OPEC, the Organisation of Petroleum Exporting Countries. Very small number of countries basically have a grouping together, and they will try and set the amount of production that they do of oil, which is going to directly influence it. Remember substitutes as well for the commodities as well is going to affect the prices, as well as inventories and weather. So if you've got a lot of agricultural products and you see particularly bad weather, likely you're going to start seeing a rise in price because it's going to be less produced. That's going to drive up the prices. Likewise, if you've got a large inventory of agricultural things that will spoil, these may have to get dumped, so they will sell them off at any price to get some kind of return on them. So do remember those inventories and weather related issues with commodities. These are the things you really need to be focusing on. Couple of little anomalies in commodities, gold in particular. Gold is not particularly used for manufacturing like a lot of the more heavy metals. Gold is often seen as a bit of inflation hedge. So if inflation is going up, your returns are falling on anything related to interest rates, but you may well see gold going up as well, because if you're buying gold, inflation is going to drive the value of gold up, and therefore you're still going to gain some capital appreciation. It is also seen as a bit of a safety play as well. Times of uncertainty, if you're not willing to buy bonds because you don't even trust governments, buy gold. It's physical. You have got some gold, so you've still got something there, even if the world does fall apart. Finally, on to what we're going to trade, futures, and also their close companion, options. Now, the whole point of futures is for hedging purposes. So we'll stick right in the middle of this a bit of a graph. We'll call this 80 and we'll call this 100. So we'll use this for the examples. Point of futures and options is for hedging. So what you can do with a future is you can guarantee that you pay a price now, price X, for X amount, say 1,000 barrels of oil in 3 months' time when the futures contract expires. Now, what this means is you have guaranteed the amount of money you're going to save. You risk no fluctuation. So say you have paid 80 for those oil futures, so you paid $80 for them. You know that whatever happens in 3 months' time, you're going to get them for 80. So in this case, you've got them a little bit cheaper than what the market's currently trading at. But you've also managed to get them here just before we see this big move up. However, if 3 months' time was here, you then would have ended up paying 80 for something that's now trading at 60. So you're losing out. Thing with the futures is it guarantees you that you're going to get that product at that price. What it doesn't do is compensate for the fact that you could end up paying over the odds come a certain time. But the point is it hedges your cash flow, so you are guaranteed to get that price that you want. You can sell the futures as well, of course. If you start seeing the price drop below 80, you could sell a futures contract. What would happen there is the gain that you make on that futures contract would hopefully be able to cover your loss. Say if you're selling the actual product for 80, if you start seeing values fall, you're going to still have to sell the product for 80. You may well have agreed that already, but if you sell a futures contract, what you lose out in the actual selling cost, you will make up with the futures contract. Now with options, what these do is these will provide you a little bit more insurance for a small cost. So you pay your option premium, and say you buy a call. What a call does is it gives you the right to buy, but not the obligation at a certain point in the future. A put gives you the right to sell. So if, say, you're trading at 80s, you're quite happy to buy the oil at 100, but you do not want to pay any more than that. Currently, though, you'd have it at 80. So what you can do is you can buy a call for, say, 100. So your call will cost you less. So say your call costs you 10. That's the premium that you pay on it. And your call is for $100. What happens is if the price starts trading above 100 on the expiry of that call, you then exercise your right to buy for 100. You've also paid a premium as well, so you've effectively paid 110. But if the oil is trading at 120, then you have saved yourself $10 per barrel. So that's why you have the options, because it doesn't force you to take anything at the price you've already agreed. You can, if it is trading lower than 100, then you can just buy it at that price, forego the 10 that you paid out in insurance, but you are still better off by doing it that way. So do think about that. In terms of what you really need to be thinking about with the options is, if you do see this move up and there is knowledge that there are quite a lot of calls that say 100, what's going to happen when they expire? The market will then get sold because people have all of a sudden got their product at 100 and they then want to get rid of it, sell it off at 120 to bank that profit. So you can then often see a flow the other way as those people who now own the futures get out. So that's what you need to remember with futures and options. This is the key thing that we're trading. In terms of leverage as well, that is the other big area. With leverage, what it means is you can make a larger amount of money with a smaller amount down. So one futures contract, one oil contract equals 1,000 barrels of oil. Currently, oil's trading around about $50 a barrel. So effectively, if you buy one futures contract, you own $1,000 barrels, $50,000 is the value of that contract, okay? So what this means is you do not need very much movement to actually make quite a lot of money. If the price of oil falls down to 49, the futures contract will move by $1 per barrel. So it is going to cost you $1,000 to see that $1 move. So that's where the leverage comes in terms of it can offer you quite a lot of money in terms of how much you can make. You can make $1,000, but it is going to give you quite a large risk as well, because you don't have to pay the 50,000. The leverage comes in whereby you have a margin of say 5,000 that you have to maintain to hold that one contract. So therefore, for 5,000 down, you could have a swing of $1,000, which is 20% of the 5,000. So that's where the leverage comes in. You know, you don't need so much money down to actually make quite a lot. Now, last thing you want to remember is different participants always, and this is the key thing to remember from the first day, what is their motivation? So are they short term? Are they actual traders? If you've got a short-term trader, or traders in general are shorter term, they are purely looking for movements in the market. So they are likely to get out if the market starts moving against them. They are unlikely to just hold on. So what you've got to think about is, if say a market is moving up, you're going to have quite a few shorter term traders who perhaps have sold it on this move back down, and they are going to get out and buy it on this move up. That's the thing with the shorter term traders. Longer term traders, you know, funds, investment funds, pension funds, hedge funds, they are a bit longer term. They don't care about these small moves. If they're buying this market, they will buy it all the way up. They will buy the dips back. They will continue buying. Right? Obviously, they are going to look to buy on the pullbacks, on the dips back down. But ultimately, if they need to buy, they are going to buy, and they will drive the market. So remember that. Remember what these funds want, why they are in those positions. Also, remember that these longer term funds aren't going to look at the smaller charts that we're going to look at. So therefore, they will get out if they need to. If they decide they need to cash in an investment, they will sell it wherever the market is trading at. Also, remember that a lot of the time, things are done as hedges. So it is not purely all about owning just one thing, just looking for a return. Market's hedged, so there will likely be two sides to a trade. So you could see, for example, someone would buy oil against natural gas, expecting some kind of rise in oil prices. The point is that if commodity prices in total rise, the oil should rise more than natural gas. That is the idea of that hedged trade in that sense, so a sort of pairs type trade. So do always keep in mind what is their motivation. That is the key thing when you're trading. Always think about why people are in those positions. What are they likely to do with them? What is likely to start moving a market in one way or another? So that's what you need to remember for day one. Different influences on those certain markets, and then when it comes down to the participants, what is their motivation? Why are they trading? And is that likely to initiate a larger or a smaller move?